What's up, everybody, and welcome to another episode of Cash Flow Conversations. Today, I have a fun little guest from New Jersey. We have Mr. Christopher Freeman, who is an independent sales rep and helps auto body shops with the parts to fix cars that have been damaged. So, Chris and I have been talking for quite a while now, and he sees a need in his business for business owners and understanding how to replace their bank. And so today's episode, we're going to talk about how to replace your bank using the same financial principles that banks use. We just want to cut them out of the deal. So, Chris, it's good to have you here, man.
Thank you for having me. I'm excited to dive into this topic.
Okay, before we get started, that's a killer beard. How long have we been growing this beard now?
It's on and off, but it was actually longer, believe it or not. And my girlfriend said you got to do something with that.
You look like Al Qaeda.
Yeah, I get that a lot. I hear those jokes every now and then.
That's funny, man. So give us a quick update. Describe your business. You work with shop owners and supplying them with the parts to fix cars that have been damaged.
Yeah, so I work with various dealers, mainly in Pennsylvania and New Jersey. And my job is really to go out to body shops in the area that I oversee, and I try to get them to purchase the parts from the dealers that I represent. So obviously, being in a car accident is not a fun experience for anyone. It's something that, God willing, you don't want to see your friends, family, loved ones ever get into that situation, but it is a reality that it does happen. And it's kind of a line of work that most people don't know the ins and outs of it just because of that reason. It's not something that you encounter every day. So a lot of the shops that I deal with, they try to take that situation and, make the customers feel at ease that, their car's in, a good place. They're going to take care of them. And it's a lot of moving pieces between the parts, the labor, the insurance companies. So a lot of these business owners that I do work with, they have a lot of overhead expenses that they're dealing with day in and day out. But yeah, that's pretty much the gist of what I do is mainly the middleman between the body shops and the dealers that I work with.
Love it. And so you've been you see the need where these shop owners are carrying the cost for sometimes 30, 60, 90 days. Talk to me about that. What is the big problem that you saw that these shop owners are going through that you think you could help alleviate?
Well, one of the biggest things that I do see in a lot of shops is that you can't really determine all the time what cars are coming in, whether it's going to be a busy month or a slow month. They can look at, what they have scheduled, and sometimes they're booking out 2, 3 months in advance, and other times they have openings for the next week. But the biggest thing that I saw is that some of these shops were having an issue that if they're a COD customer, which means they pay for their parts on delivery, and they are waiting for the insurance companies to pay them for that job. Now all of a sudden they've already put an outlay of 10, 15, 20,000, whatever the cost may be for those parts, and they're waiting for the insurance company to pay them. And it's a cash flow nightmare for them because now they have all this money out on the street and they're waiting for the insurance to pay them. And with some of the insurance companies, some are better than others, but they run a huge business, so they're overlooking everything and making sure that every I's dotted, T's crossed before they pay them out. And for the shop owners, some of them can get into a tough situation sometimes with that because, like I said, they have a lot of money on the street and they have nothing coming in.
And then what's the alternative way to do it if they're not COD?
So then, if they're not COD, they're a charge account. So they just sign for the parts and then they'll get a monthly statement. So even in that case, you get your monthly statement. If you don't have the funds to pay it off, you go into 60 days, 90 days, and then you're at risk with the dealer saying, hey, we're cutting you off. You're 90 days behind and you haven't paid your bill.
Is there
So
interest
it's
associated with that? Just they get 90 days to pay.
Yeah, you get 90 days to pay, but then you're also, you're worried about getting cut off from the dealer. And now you go to order parts and they say, hey, we can't sell to you. So now you can't buy parts from that dealer who you've done business with, but also, you got 3 months of a bill that, you have to pay.
Yeah. And so what the irony that I see is that when a business owner, entrepreneur is working with a traditional financial planner, they want the business owner to separate themselves with their money and invest in someone else's business on Wall Street in the form of stocks or mutual funds. And
Yeah.
then CPAs come alongside them as historians and say, let me look at your books, what you did the last year, and let me try and find some deductions. Oh, by the way, we can defer tax by putting it into a SEP IRA or a 401k. It's not a tax deduction, it's a tax deferral. But the CPAs typically say it's a deduction because it's deducted in the year that you make the contribution into that account. So this is twofold that hurts a business owner. Not only are they giving up use of the money, you ever wonder why you get a deduction in the year that you make a contribution to a 401k? Because you never took the money. Of course, you're not going to pay tax on money you've never gotten. Like, hello. And so,
Yeah.
you're kicking the can down the road, and you've given up all the use. They can't.
Yeah.
A business owner can't use a 401k or a SEP IRA for their own business. The money's tied up into a qualified government-controlled asset. So, as the traditional financial planning, does that make sense? The way that I said that?
Yeah. So there's a big difference between deferred and a deduction, and I think, am I understanding that correctly? Because even myself, like, just not understanding the difference of a tax deferral as opposed to a tax deduction, which I'm
Bro,
sure a lot of business owners are very aware of.
well, I don't think they're aware of it. I think they're tricked. I think they think they understand it because they're taking a deduction in the year that they made the contribution. But what they're not doing the calculation on, and no CPA in the country can do this calculation on, is how much tax are you going to pay at the exit?
Yeah.
When you do spend the money, where are tax rates going to go 20 years from now? We have no idea.
Yeah.
So I'm deferring the tax to a future date, and the debt keeps going up in the government. The only way that the government makes money is what? They don't sell a widget. They just tax the citizens until Trump created the External Revenue Service, which I think is pretty interesting.
Or they cut costs, which before now, was never an idea of ever happening. But
And look at all the
who
pushback that
knows?
they're getting on that Doge, like the Ramaswamy and Elon. They're getting pushback. It's like, why would you not want efficiency with the way that they're spending our money?
Exactly.
So to your point, it's crucial to understand the difference of a deduction and a deferral. And a deferral, given you're going to postpone the tax bill, which isn't that big of a deal until the time comes to spend the money. Because if you die, your spouse takes it, your kids take, then there's a huge tax problem. But as a business owner, what you're trying to solve is access to capital is actually pretty important. And when I understand banking principles, it's actually less risky to replace the bank than it is to fund a retirement account invested in Wall Street, the big casino, and the government's holding the strings on how much you're going to actually be able to pull out if you make it to retirement. So for every business owner you work with, this will be great because you can send it out to all of your friends. The idea isn't to take more risk to get a better rate of return. The idea is to become more efficient with the cash flow that you already have. So these shop owners can't control how many accidents they're going to fix in a month. So their cash flow is up and down, but they sure as heck can control how they pay for all of those parts. And so the idea is that we want to replace the bank, the cash on delivery idea where you're just waiting to get reimbursed. I bet you most of those business owners are using cash from a bank account. And when the cash is in the bank account, what kind of rate of return is it getting? Not very good. And it's taxable, by the way, too. You get a 1099 on that growth. So when I take the money out, I'm losing what that money could have earned me for those 60 to 90 days. And this is, I think, where you started to say, well, look, if they know that they have this account that's just going up and down, like when I make a $20,000 deposit, I have 20 grand. Then when I take it out, it's gone. And then I put 20 grand, it's 20 grand. And we can improve on that through what's called infinite banking principles. I'm not a huge fan of that term. I like the idea of just replacing the bank, because when you start to do the math on the opportunity cost, if I got 50 grand in the account, I take 20 grand out to go buy the parts, and I'm waiting to replenish that. The money that I've taken out of the account is not earning any interest. That's called opportunity cost. Yeah. And you better believe it's real, dude. I mean, this is why banks, you're in New Jersey, any buildings down there that say, 30 stories high that say Bank of America or Chase or Wells Fargo, or, my buddy always would joke, this is why banks own big buildings and we own all the little ones. It's simple economics. It's called arbitrage and understanding how banking principles work. So that's the problem. The financial industry doesn't teach this because they want you to invest in Wall Street. Your CPA is a historian trying to find deductions, and they're telling you a deferral is a deduction, and it's not. And no one's
Yeah.
helping the business owner just to understand how banking principles work, which is what we do. So I say let's dive in, dude. Am I hitting the nail on the head? Is that what we want to talk about?
Yeah. Yeah. No, 100%. 100%.
So what do you think would be some of the best or the earliest principles you started to learn that you think would be important for your clients to learn?
Well, I think, I mean, the big thing that you just said was just the access to capital and liquidity, because I think any business owner, anybody kind of entrepreneurial, whatever endeavor you're going out, even if you're not, opportunity comes up. If you don't have capital, that opportunity is going to pass you by. The access to liquidity is huge. And just what you said, just about the ability to pay for the parts, but there's so many overhead expenses that they see on a day in and day out basis, where whether the parts is one thing, but equipment is huge. When you have to go out and you have to get a new frame machine or paint booth. And mind you, this might not be purchases that you're making every year, but when they do come up, those are costly expenses that you have to make. Another big thing that I see from a lot of business owners that I talk to is certifications, to be a certified shop to work on a certain car line. So if you own a body shop and you're Honda certified, the insurance companies are going to put that in, that you're a Honda certified shop, which a lot of business owners, it's a business expense that you can put into the business. And you're hoping that if you're in an area that does a lot of Hondas, that's going to be a good return on investments. Those certifications are not cheap. You have to pay
Mm-hmm.
for those certifications. You have to
Mm-hmm.
pay for certain equipment to meet the standards of those certifications. You have to update that equipment every few years to make sure that you qualify for the standards that the manufacturer puts out. All these are expenses that I always wonder, how are you financing them? Are you taking the opportunity on that? Are you saying, it's something I think I would like to do, but I don't know if the 200,000 is worth that kind of investment. Now, if you had a vehicle and the ability where you could borrow from that, which is what we're talking about, maybe you have a different discussion.
100.
So
Yeah.
I wanted to see what your thoughts were on something like that, because I do hear a lot from business owners regarding those topics as well.
So what we're starting to talk about is my second favorite four-letter word: debt. And debt, when used correctly, can be a phenomenal wealth building tool. Normally when I say that, people go, "Well, what's your favorite four-letter word?" And I'm not going to answer that. I'll just let everybody.
We don't need to go there.
No, I didn't go. So the idea is, how do I create an account that's guaranteed to grow, ideally tax-free, that I can leverage as debt? Here's how we set things up at Cashflow Architects. I start an account that's guaranteed to grow tax-free. And instead of putting money into retirement accounts that's government controlled, postponing a tax bill, invested in the casino of Wall Street, other people's businesses, I want to invest in myself and my ability to grow my business. So I put my money into these accounts, into our strategy, guaranteed to grow tax free. Let's say I have $100,000. Well, I got to carry some debt this month. I got to buy parts. So if I take $20,000 out as a loan, I'm going to pay an interest rate on the loan that, because it's a business expense, now the IRS is incentivizing me to take that loan. They allow me to deduct the cost. Okay, so if it's a 5% loan, it's actually not truly 5%, because I'm going to deduct 30% of that. But the key part that business owners really start to fall in love with is that while I had 100 grand and I took 20 out to go buy parts, the $100,000 is still earning interest and dividends tax free. So that when I put my 20 grand back in, it might be worth $22,000. Okay,
Gotcha. Because you
so the way
didn't
that we structure
interrupt
these, say that again.
because you didn't interrupt any of that growth in that, because you're just taking a loan, but you're not interrupting it, which is a huge thing.
It's huge. Interrupted compounding interest is what people want, but what people talk about is, invest in the market, it's compounding forever. Dude, here's my rule of thumb: if the account can go backwards, you're not compounding. If my stock and portfolio, my retirement account, can go down 20% like it did in 2022, you're not
Yeah.
compounding. So uninterrupted compounding over life is how you actually take advantage of compounding. So I want to start an account that's guaranteed to compound for the rest of my life, overfund it so there's capital in there that I can use on my business, and then my retirement strategy can fund all of my business purchases. So now I'm building my business, which your biggest rate of return is going to be growing your own business, not investing in somebody else's. It's growing your own business. So having capital, access to that capital, and not giving your money to Wall Street, your financial planner, and the CPA through dumb decisions, and
Yeah.
understanding the exit so that I can run my company smoothly. Let's talk about peace of mind now. Like if you knew that you had access to capital and not worry about
Yeah.
90-day payoffs because your capital's still compounding as if all the money was in there, all of a sudden you're going to sleep easier at night. So
Yeah. So no, so I just want to touch on that because what you're saying is in these retirement accounts that so many of the business owners usually put their money into, not only are, you if you take that money out, which you don't even have the ability to do. This we're saying that you can borrow and have liquidity and borrow from your own capital, all while not interrupting the compound growth. But over on the other side, you don't even have access to take it out. And if you do, you are interrupting any compound growth that you did have, plus the penalties and the taxes that you would pay on that.
100%, dude. You pay taxes, you pay penalties, and you've lost whatever growth it could have given you. And when we understand wealth, we understand leverage, other people's money or debt.
Yeah.
And by the way, debt is tax-free. Ask Elon Musk. So when I go into debt, the government's incentivizing me, especially if it's for a business, they allow me to deduct any of that interest. And so we use overfunded life insurance because of the tax code. It's income tax free. So I'm growing this account off the radar screen of the IRS for income tax purposes. I can leverage this account long before retirement years, and the gross value is continuing to compound. So the more that I put in, the more it's going to be growing, and that becomes my capital instead of just going to the bank. So we get to a point 7 or 10 years in, I make a $20,000 contribution to the life insurance and it turns into $40,000 overnight. Bro, that's the coolest part. After the compounding starts to take, people go, well, Matt, why would I do this? I can just pay cash. Then continue to pay cash. And 10 years from now, when you make a deposit, whatever you put in is what's available. With life insurance, at some point when I put money in, that cash, the cash value available could double overnight. And so now I've taken care of my family with a death benefit. I'm good. So any debt that I have outstanding can be paid off because of the income tax-free death benefit. I have access to capital through loans my entire career, no restrictions on age. And if I just wanted to pull the cash out, I could pull the cash out just like I do with the bank. I don't have to borrow against the life insurance. I can just pull the cash out as if it was a bank account. So tell me why somebody wouldn't do this. The only reason you can't is if, the problem is health. If health is an issue, then, that all of a sudden doesn't become attractive. But if I'm healthy, I don't want to make my big deposits into a bank. I want to make big deposits into my dead self and then leverage that over and over again before retirement and before I die.
That's powerful. Because the way when you draw it out like that, it just sounds, it's so obvious as to how attractive, this vehicle would be.
And then people go, well, what's the rate of return? It's like, dude, you're fun question, but wrong question because it's good. What's the rate of return on the debt that you have now? Not good. What's the rate of return on your savings account? Not good. What's the rate of return on your 401k? Who cares? It's not your money. Of all of the accounts and things I could leverage, I could use a home equity line of credit to do the same thing I'm talking about. There's a ton of red tape there. I like it for certain things, but when you do pros and cons, it's just not the first thing I would go to. I could leverage a savings account. I could borrow against the savings account, but my savings account's not really earning anything. I am not allowed to post my retirement account as collateral. You can't. If you do, the IRS assumes all of it is distributed. You owe penalties and taxes on all of it.
So I'm glad you brought that up because I think a lot of the business owners, when we do start talking about, borrowing against the cash value and making purchases outside, starting the actual process of financing their business, what is the timetable in terms of repayment on this loan, the interest rate? What factors do they have to consider with that?
Bro, that's the coolest part of the conversation. So if I go to a bank and get a loan on a car, how often do I have to make payments?
Every month.
And if I don't,
they take the car.
And then good luck getting a loan for the next 7 years, right? Yeah. When I fund a life insurance contract, I'm telling the insurance company that they're on the hook to pay my family when I'm dead. So if I borrow against my death benefit up to the cash value that's available, this is all great concepts. Do they care if I repay it? No. Because if I take the money out and never put it back in, They'll just
Yeah.
reduce the death benefit that goes to my family by the amount that I took out plus any interest that might have been accruing. So my family gets more tax-free than they would have had if the money was in a bank account.
Yeah.
But I don't want to die. So I start to make payments back, like your boys, like 60, 90 days before they get reimbursed. Well, imagine having that account continuing to grow. And then when you having 60, 90 days, a loan outstanding doesn't show up on a credit report, doesn't hurt your credit score. There is no monthly repayment requirements because they'll just take it off the death benefit if you die. But when you're ready to pay it off, go ahead and pay it off plus interest when you're ready.
Yeah. Yeah.
So the consumer's in control. It is an off the radar screen type of a loan. It's called a non-recourse loan because the collateral, like when you get a car loan, what's the collateral? The car.
The car.
The bank would take the car. If I get a home loan, what's the collateral? The house. If I get a business loan, what's the collateral? My income. If I get a life insurance loan, what's my collateral? My dead self. And if I don't die before retirement, the odds of dying in retirement are pretty good. So the insurance company knows they're going to be able to recoup all of the cost. I'm just creating an account that's guaranteed to grow tax-free that I can leverage for my business. No market risk.
Yeah.
So the terms are extremely attractive for business owners whose income goes up and down every month.
So let me ask you, Matt, if they take a loan out and they have, a slow month or a slow year, whatever the case may be, they don't have to pay that loan back. But if I'm understanding it correctly, the fact that they're taking out a certain amount of their cash value that they have available, they go and they put it on equipment, parts, certificate, whatever the case may be. Their money's still in there growing, compounding that we discussed, but it would make sense for them when they do get money coming in from to put it back in plus the interest, because then they're going to be able to rinse and repeat this cycle over and over again.
100%, Chris. I'm glad you said
not losing.
Exactly. And so you structure these policies with flexibility. The idea is, as a business owner working, we want to repay the loans, and we can structure the premium so that you can still make this work. And then when cash flow is a little better, you can use extra cash to pay it off. And there's so many ways to make that work. But to your point, we do want to pay the interest. We want to pay back the loans. We don't want to create some big loan against life insurance. And I'm not saying put money into a policy and then go buy tennis shoes. Okay. I'm saying go instead of funding your retirement account that your advisors are lying to you about, put the money into yourself and then leverage that over and over. And yes, repay the loan, repay the interest. And there's ways to control this. And we have, meetings every 6 months or a year with our clients. And then in retirement years, let's say you do sell the business. If that cash value that's amazingly grown for that, for that long, I can leverage that cash value in retirement years. Maybe I don't want to repay it. Maybe I'm just surrendering cost basis to live on and for tax-free income and then borrowing. But those are, the fun part about it is I don't have to make that decision today. But I'm in control when I do make the decision. If I continue, and as an alternative, if I continue to fund retirement accounts, I'm at the mercy of what the IRS decides when I go to retire. They have the control, not me. And most business owners are kind of obsessed with controlling things, And this is why I think the industry doesn't teach it, because they make a lot more money on fees. Same way Netflix charges you a monthly fee, and for $100 you can't buy Netflix for life. No, you're going to pay a fee every single month. It becomes much more valuable to Netflix. And the financial industry, fee-based industry, it's the oldest subscription model in the books. Yeah, so we want to repay the loans as we're going, especially as a business owner, and we structure those policies so that you have a ton of flexibility inside of there.
But that makes so much sense, because while they're working, you're in your working years and you're taking this money out, hopefully reinvesting, like you said, into the business to make it more profitable, getting that return on investment, not going out buying tennis shoes. You're going to want to refund it back because you're going to want to do this cycle again and again, to the point where when it is time to sell or go into the retirement, you have a fully funded account that you paid back plus the interest. So you can take anything out for the rest of your life at that point and not worry about it.
Done, dude. Isn't it simple?
That's amazing.
The world tries to make things complicated because they want you to think you need to use them.
Yeah.
It's not that complicated. And unless your net worth is over 20 million, we're not even talking about estate issues typically. It's just income and business ownership. And unfortunately, most CPAs are historians. They don't do strategy looking forward. They just look backwards. And financial advisors aren't typically aren't good with their own money, and they put you in managed accounts in the massive casino called Wall Street. And so people are taught to ask, like, what's the rate of return of the insurance? Wrong question. If you had access to capital today to fund your business and double your revenue in business, what's that rate of return to you? By the way, the life insurance is going to continue to grow, so it's good. But do you really care if it's 9% versus 6 versus 4? No. You want access to capital when you want your business to grow. And every business owner knows the importance of having access to capital. And that's why a lot of them have lines of credit at the bank. Dude, people have lines of credit at the bank using their money to pay off one of the best tax deductions called a mortgage, because I can go 30 years on a fixed rate mortgage because they want to be debt free. Dumbest thing ever, because I could go on. That's a whole other podcast. They're paying off their house, so they have equity in their home they can't get access to, and they're funding a retirement account because they think they need a retirement account to retire. You don't need a retirement account to retire. You need money. And where your money sits is more important than the rate of return, because look at the fees, the market volatility, and the taxation. Net all those numbers out, all of a sudden the rate of return on insurance looks really darn good because I could leverage it over and over again. So you have these business owners who are taught by financial planners to invest in somebody else's business, never use the money, and then just scrape by their bootstraps to make the business work. The business owner is taking all the risk in that transaction, all of it. The risk of the business, the risk of the employees, the insurance, the overhead that they carry, and then they're going to invest in the Wall Street that can go down 20, 30% in a year. The advisor doesn't take risk. The CPA is not taking risk. The consumer's taking the risk, and they're giving up the control. I think the world wants to know the alternative. They don't need to go through all that.
Yes. Yeah. It's such a different way of thinking about things, but like you said, it's simple. It makes sense. It's just, you don't hear it a lot. You just don't hear it because we've been taught for years and years that this is where you put your money. You work, you invest it, you put it here.
Work. So think about this too, Chris. Who do we learn from? Now the interweb machine. We've learned a lot more in the last 20 years. But before that, it was like you had to have a super high net worth to even talk about life insurance with some of those big financial companies.
Yeah, and I think too that life insurance as a whole, I don't know, it doesn't always get the best rep. Where you hear life insurance and you think, well, it's death benefit, and that's all it is. You hear this model and you say, wait a second, you can use that same tool of life insurance and be able to actually access it while you're alive and invest in, other opportunities, businesses, whatever the case may be, all through that same asset of life insurance.
Exactly right. That's why I wrote the book, The Entrepreneur's Asset, and it talks about how to leverage your dead self over and over to buy cash flowing assets, real estate or business. And the IRS loves it, dude. They incentivize those moves. They don't incentivize retirement accounts. Do the math. There's no tax savings. If tax rates go up, you have now put yourself in a position to pay higher taxes than you ever would have just by postponing. So you've given up the use for 20 years, and you're going to pay more in taxes on the exit if tax rates go up or if you're making more money. And so the only way and let's reverse that sentence. The only way for traditional retirement accounts to work is that tax rates go down or you live on less money in retirement. I've never had a client say, show me how to go broke in retirement years so I can enjoy my grandkids on less income.
Yeah. You work that hard your whole life, and now you're going to live on less and less and less.
Yep. It's a crock. If anybody wants to learn more, click the links below. We have tons of links for resources. You can get access to the book. You can get access to Chris's calendar. You can get access to my calendar. Any other final thoughts before I let you go?
No, I mean, I the one thing is if someone hears this and they're interested and they want to get started, obviously, get in contact with you. But do you need a certain amount of capital to get started? How does that work with business owners that maybe are cash heavy? Some are a little thin right now. Like, do they have to have a certain amount saved up? What's your thoughts on that?
My thought is there's an old saying about when was the best time to plant a tree, 20 years ago. What's the next best time is today. So is there a dollar amount? No. But if you have money in the bank, then it's worth a conversation. Can we make it more efficient? What my team is good at too is helping people identify money that they're losing unknowingly and unnecessarily, just through transactions that they think are benefiting them. And the biggest one that I see is overfunding mortgage payments, overfunding retirement accounts, and paying off good debt and keeping bad debt. So there's very seldomly do we work with a client where we can't improve their situation. Does that mean they buy a big life insurance policy right away? No, but we certainly can get them in the right direction. I would say always set up a call with one of our team members, and then they can walk you through like what the next steps might be. And if it makes sense and they're ready to go, then yeah, we'll hook it up on and start looking at how a policy would work for them.
Okay. Okay.
Let's do this. Everybody listening wants to set up a call. In the description, there'll be a link. They can set up a one-on-one call with someone from our team. Let us know that you heard this recording with Chris, and we can see if we can help.
Yeah, no, it sounds like a plan. A lot of good stuff today. So
Good, man. And this is a nice recording. 30 minutes in, it's perfect. So if we want to do this again, we always can. You're always invited back whenever you want to sit here and talk about life insurance, because I love talking about it. I never thought I would be talking about life insurance, but I was an architect, and then I needed access to capital in my mid-20s for reasons I don't want to go into now. And I leveraged the insurance. And at the time, I was funding a retirement account. I mean, I was in the smallest tax bracket of my life funding a retirement account, and I needed access to capital. Most of the clients that come in have a bunch of equity in their home, a bunch of money in a 401k. They might have a 529 for their kids, and they have access to nothing. Nothing. So we fixed that. I want to give you control. I want you to be able to have access to capital in any economy where the base of what you're saving for the family is guaranteed to grow tax-free. The IRS loves this stuff. Yeah, set up the call. Chris, thank you so much for being here, my friend.
Matt, thank you. It was a pleasure being here. I had a lot of fun, and I really appreciate everything that you do for everyone. All the information you put out, it's extremely beneficial. So thank you.
Well, I'm excited for all of your boys that you work with to understand, to be able to watch this, and hopefully we can improve on their situation as well. So thank you for listening. If you're not already, subscribe to the Cash Flow Conversations podcast. Click the link below to set up your one-on-one call, see if we can help you out. Chris, have a great weekend, bro.
All right, you too. Take care.
Peace. All right, we're good.